So David and Jerry were talking to us about potential signs of slowing in the economy. Ed was talking to us about recessions and saying that everyone should worry about a recession. Everyone also includes public pension systems and the plans that they run. So these are just a few of the largest public pension systems, and the plans that they run are administered by state and local governments. And those state and local government public pension plans are what I'm going to be talking about for the rest of this presentation. So to get us all on the same page and give a very rough overview of what public pension plans are, you can think of these plans as bags of money, and employees and employers, so the state and local governments, contribute money to that bag of money. The money is then invested in assets like stocks and bonds. And then when those employees retire, money is returned to them in the form of benefits that they've been promised by their state and local government employers. So with that behind us, I want to make a few main points today. One is that the macroeconomy and financial markets affect public pension plans and public pension plan finances. But these are not the only two factors that matter. We're going to look at two potential factors that could affect pension plans. One is peers. So what are the other state and local government public pension plans doing? A second factor is politics, particularly state politics. Now, when I talk about the effects on plans, I'm going to be focusing on the real return assumption that plans make. So the returns that they assume that they're going to get over the long term. And again, I want to emphasize that this is a long-term kind of decision, what plans think they're going to get, not just this year, but over many, many years. Looking at return assumptions is important because plans have to plan many years in the future because they've made these promises to their employees many, many years in the future. So that's kind of on the asset side. On the liability side, assumptions about returns are also important because public pension plans use the nominal return assumption as the discount rate when they're calculating the present value of their liabilities, so the present value of the promises they've made to their employees. Now, there's no legally mandated assumption about returns that public pension plans have to make. There's no consensus on exactly what the right return assumption is. There's variation both within a year across plans and within the same plan across time. To give you a sense of what kind of magnitude we're talking about when we talk about and think about changing the return assumptions, if you think about a plan that's promised one employee $28,000 in 20 years, going from an 8% assumed return or discount rate to a 7.25% assumed return or discount rate, increases the present value of that liability for that one employee for 1 year by over $800. Which doesn't seem like a lot, but there are millions and millions. I think now it's over 13 or 14 million employees in public pension plan systems. And those employees are going to get benefits for more than just 1 year, for many, many years. So that $800 can grow very large very quickly. So much to say that return assumptions are an important factor to look at. Also, it's relevant for the recent news. The University of California system just announced that they're going to be lowering their return assumptions. This is temporally relevant as well. So first, I want to look at how plans relate to the macroeconomy, and that's what we're seeing in this chart here. So the macroeconomy I'm roughly capturing by the unemployment rate, which is on the left axis in gold. On the right axis in blue is the percent of the required contribution paid. So that's a bit of a mouthful. What does that mean? So every year, actuaries tell state and local government employers how much they should be contributing to these public pension plans. But state and local government public pension plans are not required to do what the actuaries say or to follow the actuary's recommendation, which is why that fraction, that percent, can be, and as you can see, often is less than 100%. But what you should be taking away from this picture is that the two series, the gold one and the blue one, move in opposite directions. And they move very strongly in opposite directions, indicating that there's a strong negative correlation between the macroeconomy and public pension plan finances as measured by the percent of the required contribution. So as a quick aside, why are we looking at contributions? So contributions by state and local government employers are quite important. This picture here, this plot here, is showing you the fraction of, is essentially comparing what state and local governments contribute to their pension plans relative to what they're paying their employees in sort of annual salaries. So you can see this fraction, this percent, has grown significantly over time. And this essentially represents a burden to taxpayers of those state and local governments that are paying taxes to fund those state and local governments, which is another reason why it's important to look at contributions and why I chose to show you this series. You can also look at how plans relate to the macroeconomy, again by looking at the unemployment rate. And this time on the right axis in blue, we have the funded ratio. So what is the funded ratio? The funded ratio is essentially a plan's assets divided by a plan's liabilities. So you can think of this as what fraction of or what percent of the plan's promises do they have assets to fund. So you can see, though the relationship is a little bit less stark than what we saw in the previous slide, that there is a negative relationship here as well. When the unemployment rate increases, when we go into a recession, the funded ratio tends to fall. So that relationship is broken down a little bit in the recent years. There are many possible explanations. One possibility is that sort of the further you get into the hole, the faster you have to run to keep up, so that makes it a little bit harder, or makes it that much harder to raise that funded ratio. So that's one possible explanation. Generally, why does the funded ratio tend to fall? In recessions, one is, as we saw in the previous slide, state and local governments tend to contribute relatively less when we go into a recession. Also, to the extent that financial markets and the macroeconomy move in the same direction, the value of the assets that the plans hold tends to fall in recessions as well. So that contributes to the downward trend during recessions. This is a nice way to transition into talking about how pension plan finances interact not just with the macroeconomy, but also with financial markets. The reason is because part of this downward trend has to do with the returns that plans get on their investments. And those returns, the returns that the plans actually get on their investments, are strongly correlated with financial markets, which is what you can see here. So what you're looking at is, in blue, the real one-year returns on the S&P 500 index. And in gold dashed line, you have the average actual return that public pension plans received on their investments. So that's the real one-year return. And you can see that the two series follow each other quite well. So that's an indication of a strong positive correlation. You can also use this picture and relate it to the funded ratio, which I showed you before and I'm repeating here, to see how financial markets also affect plan finances. So if you look at these 2 years, which were particularly bad for financial markets generally, as captured by the S&P 500 index, and were also bad years for plans, those were also years when you start to see the funded ratio fall. So that's a link between financial markets and plan finances. So this is indicating that returns that plans actually experience and the financial markets are closely correlated. That's also the case when you look at the returns that plans assume and some measure of long-term financial markets. So here you're seeing the average real return assumption that plans make in gold, and in blue is the 30-year real annualized return for the S&P 500 index. So that's a little bit of a mouthful. Essentially, it's trying to capture the long-term financial market outlook. You can see that the two series move upward together. So they both are moving up over time. Statistical regression analysis can confirm that there is, in fact, a strong positive correlation between the two, and it's significant. You can also use that regression analysis to see how long-term financial markets, as measured by this 30-year return, versus year-to-year fluctuations in financial markets measured by one-year S&P 500 returns affect the return assumption. And perhaps reassuringly or not surprisingly, there's some but relatively limited evidence that recent one-year fluctuations in financial markets affect plan assumed returns. So this is saying that planned assumed returns are supposed to capture kind of long-term trends in financial markets, and that seems to be what's going on. But also, this correlation is not perfect. If it were perfect, the two lines would be exactly on top of each other, which leaves scope for other factors to potentially be affecting the return assumptions that plans make. One of those factors could be what the plan's peers are doing. And the first evidence we see for this, in support of this idea, is in this chart here. So what this chart is showing is that there are kind of these waves of changes that plans make in return assumptions. On the y-axis is the number of plans making changes to their real return assumptions. And if information about the macroeconomy and about long-term financial markets was revealed slowly and continuously over time and was learned by the plans slowly and continuously over time, you wouldn't expect to see these waves of changes. You can confirm that a plan's peers do in fact significantly affect a plan itself by running a regression analysis, which shows that there's a very strong and significant positive correlation between the changes that a plan's peers makes to its return assumption and the changes that a plan itself makes to its return assumption. So what's going on here seems to be a little bit of follow the leader. But a slightly frustrating outcome of this analysis is that we can't say, or this analysis is not designed to say, what made those leaders change their mind. So we're going to look at another factor that could potentially affect return assumptions, and that is politics, or particularly state politics. So the story here is that in a state election year where there is an incumbent governor running, that governor might find it beneficial for state finances to be in good order. And that in turn might put pressure on return assumptions to stay favorable. And by favorable, what do I mean? I mean for return assumptions to stay higher or to increase or at least not decrease. And that is a favorable outcome because thinking back to the earlier example, the higher the return assumption, the higher the discount rate, and that's going to lower the present value of a plan's liabilities, lower the present value of the plan's promises. So we would expect to see more favorable changes to return assumptions in years where there is an incumbent governor than when there is not. So some evidence for that is in this chart here. You can see that when there is an incumbent governor running, the changes to the return assumptions tend to be more favorable. They tend to be higher on average than when there's no incumbent governor running. You can run a regression analysis to confirm this qualitative pattern, but you also find out that the world is not so simple. Our story doesn't fully explain the pattern in the data because of this, the leftmost blue bar, which says that when there's no election that year, those are the years in which the changes to return assumptions are most favorable, which doesn't fit our simple story because those are years where the governor might not feel as much pressure from voters. So clearly this story doesn't explain everything. You could tell a number of other stories that fit with the data. We're not going to try to rule out one story versus another, but what we do find is that there is some scope for the political cycle, particularly the state political cycle, to be affecting the return assumptions that these plans make. So if you remember nothing else, just to quickly summarize, the macroeconomy and financial markets interact and affect plan finances and return assumptions, but these are not the only factors that could affect what plans are assuming about their returns. There's some evidence that a plan's peers matter, and that politics matter. And looking at state and local government public pension plans is a nice way to think about the connection between the macroeconomy and that outlook, which we've been talking about up until now, and financial markets and the financial outlook, which we'll hear more about later, because both of these factors seem to be affecting plans, and because plans themselves, public pension plans, are very large players in financial markets. So with that, I will turn it back over to Jerry.
Thank you.